So I don't think it's going to be a problem. And that's it. With that, I will introduce my good friend, Mr. Brian Reed. Maybe he'll tell us if the A is Alan or something else, but he'll be our moderator tonight. As you have questions throughout the presentation, please direct those to Brian, as he will introduce those to the speakers as he goes. If you have a question for a specific person on the panel, you can direct it to them as well, but they may or may not be monitoring their chat. And Brian will work those questions in either at the end or throughout the presentation as applicable. So with that, and now the 15-minute starts, Brian Reed. Brian on mute. Is Brian with us?
Brian is on mute. Yes, the A does stand for Alan. So I will kick this off and introduce quickly Jonathan Menser, who is a Senior Vice President within Capital Finance Group of UABM. Robert Ralph, who is Managing Director with TELUS Capital Advisors. And then last, but certainly not least, one of my partners, Rob Myatt, will handle the tax piece. So with that, Eric, I think you need to relinquish control so that I can share the presentation. Share. Please tell me if y'all can see that.
That was not easy for me, by the way.
What was not easy for you?
Relinquishing control.
All right. Well, you did it very well. So hopefully everybody can see the screen. If you cannot, please let me know if you cannot see anything. So with that, we will sort of kick off and start with introducing or allowing Jonathan to start his sort of presentation and overview. And again, if there's any questions that you all have, please feel free to share those with me. I will monitor that in the chat room so that I can get those questions answered in timely fashion. So with that, Jonathan, I'll hand it over to you.
Hey, Brian, we're seeing the presenter mode with the next slide. I don't know if you can change your display settings and get out of that, but
I can certainly try. What about now?
Same.
Sorry, guys. Same thing?
No, that's perfect.
There you go.
There we go.
Great.
All right.
All right. Thank you, Brian. Brian, you can go ahead and move it to the next slide. I appreciate that. Thank you for the introduction, and thank you everyone for joining us this afternoon, or I guess this evening. I'm glad we were able to regroup after being rescheduled last month due to that unfortunate week of storms. But like Brian said, my name is Jonathan Menser. I'm a Senior Vice President with UMB Bank here in Dallas in the Capital Finance team. For those of you that don't know UMB all too well, we're a Kansas City-based super regional bank, 100-plus-year-old bank. In the Capital Finance team that I'm a part of, we broadly label it as the specialty lending group within the bank. So kind of generally what I mean by that is we typically work on financing structures that are a little non-traditional from what your what your traditional commercial lending box is. So we serve clients, whether they're working on an M&A event, they're working on a growth story where the near-term leverage profile is a little bit higher than a typical commercial lending box. And we also work on turnaround situations where a company is facing an inflection point in their operating history. So a lot of the activity that we drive comes from key partnerships in private equity, investment banking, and advisory firms, generally in the middle market and lower middle market. Last year, as you can imagine, was a pretty active year because it was a volatile year, and volatility generally leads to opportunity in the markets and therefore higher transaction volume. From where we sat, really what we saw in that market activity was in three separate distinct buckets. ABL refinancings, whether a company's trying to unlock additional liquidity through their balance sheet strength, or they're in a cash flow structure and moving more towards an asset-based structure. We also saw organic growth stories. Frankly, there really was a tale of two economies last year. I mean, obviously, there were a number of spots in the economy that were facing serious challenges, but there were also some really bright spots in companies that did extremely well last year. And so we're seeking financing to help spur on that growth. And lastly, it's pretty obvious that M&A financing was pretty muted in Q2 and most of Q3. But we really saw that debt recapitalizations and minority equity recapitalizations were fairly robust, especially towards the end of the year. Next slide, Brian. Great, thanks. So credit markets last year and how we got to where we are today. Q2, it really was the quarter of PPP. Lenders and even UMB during that April, May, June timeframe, a lot of our effort was spent on helping service our existing clients, whether it was PPP applications, whether it was amendments and modifications to our lending structures. But we really did see that activity in the summertime, especially the late summertime, for new deal issuances really start to take off. There was more certainty, there was more stability in the market, so it allowed investors and borrowers to come back to the credit markets in a renewed fashion. 2020 also really was a good fundraising year. I mean, obviously, you can't compare it to the highs of 2019. But in all respects, 2020 was a good fundraising year. I think private equity investors brought in 200 billion plus of new capital, and so we believe that that'll really spur on M&A activity in 2021. The need to deploy cash, debt pricing premiums, and credit structures are kind of all back to where we were pre-pandemic in the first quarter of last year. And I think you'll see that lenders, both bank and non-bank lenders, will tolerate leverage again. There'll be an understanding and underwriting of what does earnings normalization look like going forward. Was 2020 an abnormally difficult year, and is that going to continue? Is that COVID related? And if last year was especially strong, is that something that's going to sustain going forward in 2021? Next slide, Brian. Thank you. So Casey Matthews, he's our Chief Investment Officer here at UMB Bank, and he was giving a market update earlier this year, and this was a quote from his market update, and I kind of found it interesting that while last year obviously was an extremely challenging year, in reality, from an economic perspective, from start to beginning, it really was sort of an average economic year for a recessionary event. Obviously, there were there were spots in the economy that were anything but average. Job losses obviously were fairly catastrophic, especially in April when unemployment spiked to 15%. We did see some gradual rebound in jobs throughout the year, which was a bright spot for the economy. December again was a little down. That was because of COVID cases spiking again around the holidays. But again, a bright spot that January and February of this year continue to add jobs. So we see that momentum heading into 2021 as well. Again, 2020 was largely a successful year for the economy, all things given. And I think it's a testament to the true V-shaped recovery that we exhibited. I mean, obviously, you had the huge cliff and fall off in Q2, and then a really impressive jump in Q3. The right hand of the V obviously isn't quite as tall as the left hand of the V. So overall GDP in 2020 was down, I think, 3.5 points. But again, that's pretty quite average for a recessionary event. And the economy continues to be in recovery mode as we go into 2021. Continued progress with the COVID vaccine, federal stimulus. We just saw a $1.9 trillion stimulus package push through. The Biden administration is given all indication that an infrastructure spending bill is likely on the table, and the Fed has indicated that there's going to be no movement in rates at least for 2021. So when you take all this together into an equation, you've got low rates, you've got lots of cash in the sidelines needing to be invested, and you've got tax implications that Rob is going to be diving into in his presentation later. But you mix those three things together, and you have the ingredients for a really strong M&A market in 2021. Obviously, in the outer years, there's some risks to keep an eye on. Inflation is a risk, 2-3 years down the road to keep an eye on, as well as higher deficits. But for the near-term outlook for 2021, it looks like we're expecting a really strong M&A activity.
We now have a polling question.
Oh, okay. Next, I think my next slide is.
I'm going to end the polling.
Sounds good. Yeah, I think that consensus kind of matches what I just presented. I'm not sure if everybody can see that the polling results, but
yeah, I shared them. I think next slide. Oh wait.
Okay, yeah, that's just my last slide. Just saying, I don't know if we're taking questions, or if we're going to do it at the end, but the last slide's got my contact information. So if anybody, after this event or down the road, ever has a question, please, by all means, reach out. I'd be happy to chat and take questions now or at the end. So thank you again for your time. I really appreciate the chance to speak with you all.
Okay. Well, next we will move on to Robert. I don't see any specific questions. If there are any, Jonathan, if there are any questions that come up, I will leave those till the end. We'll circle back. So with that, we will move over to Robert and let him sort of dive in.
Thanks, Brian. I appreciate it. I'm Robert Ruff, TELUS Capital Advisors. We are a lower middle market investment bank here in DFW. And we do two things. We sell companies and we help companies raise capital. And maybe a little bit of a master of the obvious statement here, but COVID-19 caught everybody by surprise last year. And it really threw the M&A market into just a freeze down. Of over 50%, and these are from a AIM and AA Dealware survey of national private equity and intermediaries. Over 50% of the deals that were in progress in February had been suspended or terminated. And funny enough, Telos Capital, we had that exact experience. We went into COVID with 4 deals active, and 2 of them just went into hiatus, just suspended. The other 2 were sell-side deals, and we were able to get them completed, although, as I'll talk about later, it took longer. So March, April, and May, there was just no deals in the market, really nothing. And then there was some improvement during the summer, again, of new deals launched. And when we talk about deals launched, that's when they're put into the market and first marketed. You have to understand that there's usually 2 to 3 months worth of work behind that, before that happens, behind the scenes of getting the company ready and preparing documents and things like that. September and October, people got really excited because deal activity was higher than normal, but things died in November and December, even lower than they normally do. So net 2020 deal closings were down. Again, not surprisingly, there were so many industries that were negatively impacted by the pandemic. So not surprising, the number of closed deals declined for the year. Go ahead, Brian.
Well, I have a couple questions. So the first is, do you think you will, the due diligence compared to 2020 during COVID period will relax, or do you think it will continue to increase the due diligence efforts?
I don't know that there was, I think the challenge with 2020 was there was a lot more to do due diligence on. I mean, you not only had to figure out all the normal due diligence things, but then you had to figure out and diligence how the company was going to move forward. Were they in person? Were they remote? How were they handling that? What were they going to do when COVID ended or ends, assuming it does? And then you had to really understand if there were changes in revenue, positive or negative. You had to really do some analysis to try to understand when that would change. We'll talk a little bit about that in upcoming slide.
Yep, and I'm happy to. I have an opinion about this, so if you wanted me to ask, I can't give you mine. But then the second question is, and you may not want to touch this question, but can you touch on geopolitical risks for 2021 and the impact, if any, on the M&A market?
I'll get to 2021. I'm still, I'm building up to this,
Yeah.
trying to build the suspense.
Okay, well, then we can kind of circle back on that, but there's some questions on whether what the geopolitical risk and impact on sort of current economy,
Okay.
specifically on the M&A market. So
yeah.
All right, we'll circle back to that question. We'll move to the next slide.
Okay. Not sure what happened to my titles there, but so here's sort of what happened. Industries that weren't impacted by COVID-19 or where the path to normal was somewhat predictable did fine. We sold an air ambulance company last year. There was no doubt that business was just going to be returned to normal at some point. Obviously, with the shutdown, people weren't out on the roads doing silly things or in factories, hurting themselves. But there was no doubt that that industry would return to normal. where there was a question, and this gets back to that due diligence question, if you couldn't figure out when a company would return to pre-pandemic results, a lot of times people would use earnouts to bridge those gaps. And it would be, okay, well, let's say the deal is going to be 5 times EBITDA or something. You know, we'll pay you 5 times your current trailing 12 months EBITDA, and then we'll make another payment in a year based on 2021 or whatever the whatever the deal negotiated. We'll pay you 5 times 2021s, or maybe even 5.5 times 2021 differential in EBITDA, so allowing you to make it up. Equity capital was used, as Jonathan mentioned. You know, for a brief period there was a real freeze in even some of the credit markets, and so private equity groups were using much more equity capital to close. Valuations increased. You can see the details there. Anecdotally, I can tell you that company that we sold, the closing price, which it closed after COVID hit, was about 25% higher than the indications of interest we had received prior to COVID. So I think there was a real fear of missing out, number one. And number two, just scarcity of product. Then, you know, certain industries obviously did better than others. And transactions definitely took longer to close. I would say the 2 transactions we closed, one probably took 2 months longer than it should have or would have, and the other probably was in the 3-month plus category. I think some of that was people adjusting to remote activity. Management meetings suddenly had to be conducted via Zoom and other technologies. And I think people just really had to get used to the idea of not being able to spend face-to-face time between the potential buyer and the seller. No surprise that strategics and PEs were the most active buyers. Remember, PEs raise funds and they have to deploy them. And so COVID or no COVID, they've got a limited amount of time to deploy their funds generally. And so they were trying to get deals done regardless. And then transactions, this was an interesting thing from last year. Transactions that used advisors had a 3 times higher close rate than those without. That's actually about the norm. About 1 in 4 without an advisor will close, and about 3 out of 4 that use an advisor will generally close. So what do we expect for this year? Well, let's see. We think there's going to be a lot of transactions. Baby boomers are still aging. You know, I am a baby boomer, and I find most baby boomers that own companies, plan A is to live forever, and they don't have a plan B. I think that's starting to change a little bit, just because, you know, it's one thing to have that when you're 65, when you're 75, that gets to be a more challenging strategy. Health concerns. Age and health concerns are the 2 biggest drivers of the decision to sell a company. And it's often not the health concern of the founder owner. It is quite often the health issue with the spouse or with a friend. 2 companies, one company we sold last year, a company that we're working with currently, the spouse happens to be a wife in both cases, has some health issues that have come up. And I think the owner, the spouse, has decided that it's the right time to sell the company and move on and smell the roses, as it were. Capital gains. Oh, we got a polling question.
And Robert, I'll end the polling after 1 minute. You're more than welcome to continue the presentation as
Okay,
people
sure.
answer. We'll close it out.
No problem. I'm not going to steal Rob's thunder on the capital gains, but I will, the spoiler alert, tax rates are not going down. So you take that for what you will. COVID-19, was yet another gut punch, I think, to a lot of owners, and they're tired. Valuations continue to be crazy. I spoke with a private equity group today, a very well-known local private equity group, been in business for decades, telling me they put an offer in on a company with an enterprise value of about $35 million. And the intermediary, the investment banker, told them that they're getting offers in the high 50s. So I don't know how you get that kind of discrepancy in valuations, but apparently that's what's happening in the market. And part of that is, of course, there's tons of money out there chasing deals, as Jonathan talked about, all the money in the market. Lots of industry roll-ups in process. I noticed from that last polling question, a lot of people are anticipating doing acquisitions, and they're probably growing through acquisition. And lastly, there is a tremendous level of interest in North Texas by private equity and family offices. Everyone knows that North Texas is a great place and is growing like crazy. So anything that is impacted by growth, construction, and all those sorts of industries, service industries, are of great interest to people from out of state. Now, if you're thinking about selling, you've got this trade-off here. If maybe your results were a little bit hit by COVID, so do you wait, or do you sell now? Because there's other trade-offs, maybe health or age or whatever. I've heard some people say they want to wait until the tax issues are settled. That will be too late, and Rob's going to talk about that. But if taxes change at the end of this year and they're effective Jan 1 of next year, you should probably already be making moves towards selling, because there's going to be a rush to the exit. You can see this chart, and again, keep in mind, this is when deals are launched. So go 2 to 3 months before those dates for when a deal is actually, someone makes a decision to sell and starts moving forward. In a market like this, even though it's very hot, you still want to make sure your company is positioned properly. You want to reach a large number of potential buyers, and there still needs to be very active management of the process, because deals are taking 8 to 12 months from the time of engagement of an advisor to close. And so you think about that. If you want to close by December 31st of this year, you should engage an advisor, yesterday, to make sure that you get the deal done this year. Otherwise, there will be a lot of deals that get pushed into next year. So don't wait. And again, there's my contact info. And although you can't see it, but it's up there in the upper left-hand corner. So thanks again for your time.
All right, Rob, you are up.
Now the riveting portion of this presentation, the tax stuff.
Well, I've already told you. It's just
Brian, you're already asleep, Brian. All right. Well, just to give you a little bit of overview, I think most of you know about Weaver. Brian's probably talked about the firm. Full service audit tax advisory. Born in Fort Worth in 1960. So been in the market for 60 plus years. Now we're all over Texas, LA, New York. We're a national firm. I'm a tax partner in the Dallas office, primarily focused on energy, financial services, manufacturing, distribution. Do a lot of private equity-backed portfolio companies on the compliance side, but also heavily involved in structuring and carried interest structure, purchase price allocation. I guess approaches, entity choice, and all those types of things that go along with that. So, just wanted to talk through. Go ahead, Brian.
One correction, the firm actually started in 1950, 70 years ago. So.
Oh, 70 years ago. Yeah. I didn't say I was a math major, Brian. Yeah, just a tax guy. We go 1 + 1 = 2. So I'm not going to pretend to be a political analyst here. So I'm going to briefly touch on the current state of Congress. I think most of this is pretty simple stuff that everybody is aware of. The budget reconciliation process that we'll most likely see if and when a tax package is passed later this year. And then I think the meat of the discussion will be some of the preliminary proposed changes, which there hasn't been a lot of movement on since the election cycle came through last fall. So a lot of these things are still kind of thrown out there, and they have yet to work through a lot of the details. I think their political focus has been obviously in the COVID bill that just passed a couple weeks ago. And then finally, some planning items, entity choice, compensation type things. We'll walk through at the end. You can go next, Brian. All right, so the basics, Congress and the administration. Obviously, the Georgia race was very consequential. It ended up in the 50-50 Senate split. VP Harris is going to be the tie-breaking vote. The House Democrats control 222 to 211. Next slide. All right, so what changed? What's different? Democrats have control of the 50-50 Senate with VP Harris as the tie-breaking vote. What do they control? They control the timing of the debate and votes on any legislation. They also control committee leadership and agendas. What I've seen a lot out in the news is, okay, the 50-50, it's doom and gloom. It means, everything can get pushed through. So just to point out, simple majority vote is limited, but it does imply that the two important areas, which one has already been passed, the COVID bill, and then the tax bill, will most likely go through the 50-50 with the Harris split vote process later on. Compromise is more important than ever, especially when it comes to the tax side. It wasn't a part of the COVID bill. Obviously there's some sensitivity to that bill and the way that it was put together, but it will be a part of the tax bill. Every member's vote is key. There are some very progressive items that are being proposed. So the way I think most experts are looking at it is 50-50 doesn't necessarily mean that it's going to get 50 Democratic votes if we go to a very progressive plan. Next slide, Brian. All right, so what are the takeaways? Doesn't give Biden a free path for his priorities. He's going to have to, have some moderation. Again, a lot of the items that he's got included are major tax hikes, and some of those may have to be curbed, to get this bill to come through. If you hear the term budget reconciliation, that's a process that, basically usually in a normal year, you'll see at least 1 to 3 of these passed. Normally it's usually 1 to 2. A lot of times they use the budget reconciliation process to push through tax bills. It's a special process that makes legislation easier to pass in the Senate. It cannot be stalled in the Senate by any filibuster, doesn't need the president's signature, and it can only involve policies that change spending or revenues, There are limitations on what can and cannot be included in the budget reconciliation process. And I think that's one of the barriers in this tax bill is there's a couple of things that cannot be included that are pretty major material items. In the budget reconciliation process, it is likely if there's distinct partisan lines on the issues. So I think this is where we're headed, is towards some sort of budget reconciliation process on the tax side. Where else does the 50-50 matter? You know, we've seen the repeal executive orders of the prior president. You know, I think most of what Biden has done has been focused on COVID, economic crisis, social justice, and climate change so far. So that, you know, it does make a difference there. The committee piece again, and then, you know, the compromise piece. You know, a lot of the moderate Democrats that are out there, really the individuals that are wielding a lot of power in this process right now. All right, so what are some of the...
Rob, hold on. We have a polling question. But you can continue to talk.
Okay. So some of the proposed changes, okay, and this is not a catch-all due to time constraints. I did list here things that I thought were pretty relevant for this group. The corporation rate, which is currently 21%, it's being proposed to go to 28%. You know, the 28%, if you think about what that means, that was under prior pre-Trump law, that was basically the AMT rate. It's almost like under old law, it's the minimum tax rate that corporations would be required to pay depending on certain AMT adjustments. So the 28% is pretty relevant. You know, from what I've heard out there, you know, 21 to 20, a lot of people think that 28 is going to be too high. So watch for, you know, potentially coming down into the 24 to 26 range. You want to give results, Brian, or?
I don't.
You good?
Yeah.
Okay. Another big item for corporations would be the 15% minimum tax on corporations with book income over $1 million. You know, if you read a lot of the press clippings about, you know, big corporations not paying taxes for years and years, I think this is a piece that is intending to target, you know, the corporations that are benefiting from either, you know, deductions, reinvestment, you know, that have NOLs and are continuing to put the money back into the business, which is generating tax losses. So the target here is to basically, you know, I would put this in the same bucket as some of the net wealth proposals at the individual level. You know, they're basically setting a threshold that if you have over $100 million of book income, you automatically pay 15% tax. Another item that's out there is the bonus depreciation, which has been very, very beneficial for many years. Bonus in Section 179, scale that back from 100 to 50%. There hasn't been any talk at this point to go lower than the 50%. 50% has been in play, I think, for 13, 14 years now. So it would be pretty shocking to see that go below what it's been. And then the carried interest, and I think that's been a very controversial item where it basically requires a 3-year holding period for gains, capital gains, for individuals who hold incentive units or carried interest in a company. From what we've seen, and they issued final regs on this, the scope is very narrow. If you're invested in real estate, if you're invested in oil and gas, if you're invested in a hedge fund, you know, you should basically be keyed in on this one. I think that's current law. What Biden is focusing on is basically, you know, further restricting the current law to attack the carried interest, which results in long-term capital gain treatment for the most part. And he would basically be, you know, converting that into compensation or some portion. Go to next slide, Brian. All right, so the individual rates, the top rate, 37 to 39%. You also read in the news, you know, we're only raising taxes on individuals making over $400,000 a year. And so a lot of these are really tied to this $400,000 threshold that they've defined as what constitutes a wealthy individual. So a rate increase from 37 to 39.6, not that material. but still almost a 3% bump. The next one on the 199A, which has been a really, really sharp tax deduction that's available for pass-through entities. So if you're invested in a partnership or an S Corp that pays wages or has heavy investment in CapEx, then you potentially pay tax on only 80% of the income that flows to you on a K-1. What that results in is an effective rate of 29.6% under current law. So you're going basically from 37 to 29.6%. With the elimination of this, you would basically have a 10% increase back to the 39.6%. So that's a pretty large item that they're looking to go after for small. That's going to affect small business owners. We talked about the net worth tax proposals. There's a lot of the stuff, and it's been floating out there for years. That started, with Obama, and I know Warren has some proposals out there that would target net worth for individuals. So let's say, for example, you have net worth of $100 million and you're no longer generating substantial taxable income, then there could be law put into place basically to where you have to disclose your net worth to the IRS, pay tax on that on an annual basis. A lot of hurdles to go through on this one. Obviously, the privacy and the IRS's ability to audit and what constitutes net worth. I think there's a lot of barriers, so more to come there. Capital gains and qualified dividends. This is another big item for individual taxpayers. Basically, if you have taxable income over $1 million, then your capital gains would be taxed at 39.6 instead of the traditional, let's just call it 20%, if you're at that income level. So basically would double the tax rate. This is really terrible for the private equity industry. It's terrible for any business owner that's, thinking of selling their business. You could have individuals that maybe they haven't made a lot of money in their life and they're really punished heavily for a one-time liquidation event. So I expect to see there to be a lot of chatter about this one, and very curious as to how this moves, because it's a really detrimental law to investment. The payroll tax increase. This is one of those I mentioned earlier about the one that cannot be done through the budget reconciliation process. So the current proposal is, as of now, W-2 employees, you pay the 6.2%, and employers pay the employer portion, this other 6.2%, on wages below 137.7 adjusted for inflation. The proposed laws basically create a donut hole to where, once you start kick in and you're making above $400,000, then that 12.4% would come back. Would hit a lot of S Corp shareholders, anybody that, is dependent on large bonuses for their compensation. And so I'd be just very mindful about this one, but still going to be very difficult to pass this piece.
Hey, Rob, I have a question.
Yes.
The 400,000, the 37 to 39, is that individual filing?
That's married filing jointly. Yeah. Yeah, that's married filing jointly.
All right.
You can go ahead to the next one, Brian. All right, a few more things on the estate side. No step up in basis on death. Normally, if you die, you have zero basis asset and it's worth $1 million, your inheritance, they receive a step up in basis on that piece. The proposals to eliminate that. On the itemized deduction side, which includes, if you're not familiar with itemized deductions, it's, your interest, property taxes, charitable, all that bucket on your personal tax return. Capping the benefit at 28%, but yet making you pay tax on income at the rate of, let's say it's the top rate of 39.6%. So you basically would be losing 10 to 12% ish benefit off of your itemized deductions. Property tax cap at 10K. That's, he's putting that out there. That was really frowned upon by California and New York, high property tax states. So, proposals to take that out of it. And then the P's limitation, you can discuss that with your tax advisor, but it can really hit high income taxpayers, especially if you're giving away charity, and you have a substantial charitable donation. This one would provide a haircut. I think it's 3%. It's a 3% cut for a certain amount over your taxable income, which is can be substantial. I've seen in some cases. Eliminating tax deductions for IRA and 401k contributions, instead using a flat credit. So back to that example of getting a deduction at your max tax rate of 39.6. Instead, you would basically get a 26% benefit, so you're losing almost 14%. Student loan forgiveness, non-taxable. Interesting. I don't know where that one's going to go, but you go to the next one, Brian.
We do have a quick, we have a polling question first. That we are launching. It'll take a few minutes to answer that.
Keep going.
And while we do answer that, I have a question that was posed. All of these changes, and maybe you're going to get to this and I'm jumping the gun, but these changes, is there any indication from anything that you've heard or seen whether or not they will be effective for 2021 or 2022?
Yeah, I've got that on a slide. I've got the timing slide coming up. If you want to move forward,
We'll defer till then.
Okay. Yeah, just keep pushing forward and I'll keep going. I'm going to quickly just, what industries should you expect to see affected? Oil bad, renewables good. I mean, that's obvious from watching the news. Made in America, so bringing offshore stuff back to America. So credits associated with domestic production, technology, pharmaceuticals in the U.S. Expanding opportunity zones. This is more basically expanding and focusing more on urban areas and making sure that the right zones qualify. Eliminating 1031 exchange deferrals. So, targeting against real estate and energy is where I see that the most. You can keep going, Brian. All right. So when is it going to happen? Effective dates further in the future. All right. But no promises. The retroactive piece is very, very rare. Normally, the way the cycle plays out, you have a new president come in, they work on legislation, spring, summer, a lot of the details start taking shape. It's passed in the fall, and then it's effective the next year. Usually the only things that I've seen that have been retroactive have been things that have been beneficial. For example, a lot of the stuff in the CARES Act that surrounded COVID was retroactive, right? So there could be some of that with COVID still being a factor later in the year. I've seen also, R&D credits and other types of things effective and, cost seg studies, stuff like that, be retroactive and have a negative effect. But typically all the meat of the tax legislation, it would be effective 1/1/22. The thing that we have to look at is, and be very, very focused on is where does COVID go? Where does the economy go till the end of the year? This stuff could go, anyway. I think for the most part, people believe there will be something passed before year end and to increase taxes, and it will go into effect 1/1/22, but I would just be mindful of how things could quickly move if the economy and the combination of the economy and COVID come into play, and maybe they just kick it down the road a little bit. Did that answer your question?
Yes, you got some.
Okay. All right, so I know we're almost out of time. Just some planning thoughts. Number one, think about when you're going to close on a deal. Effective versus close date, critical. When are you starting that process? Studying what's happening with the proposed changes over this course of the summer. That way you're not late to the game, late fall. Entity choice, anytime corporate rates go up, everybody wants to convert to a partnership. Corporate rates go down, everybody wants to convert to a C Corp. There's a lot more that goes into that. Compensation planning, income recognition. So basically accelerating income, accelerating deductions, not accelerating deductions, deferring deductions to 2021 if there's a higher rate. Installment method planning, if you're entering into a deal later in the year and it involves cash received after year end, maybe you want to elect out and pay tax at a lower rate. Property taxes come back into play. If it's not going to be capped at 10,000, then that whole game about what do I pay at year end, I think comes back. And then also a lot of the CARES Act stuff, which I didn't cover here. These are just proposed changes. A lot of those expire or are set to expire at the end of 2021. So having those discussions, a lot of the benefit out of the CARES Act was with your payroll. And so having those discussions with your payroll service provider about what that looks like and what do you need to be thinking about before year end is pretty critical. One more. This is just an entity choice slide. It's really just talks about corporations and if you're thinking about entity choice, you have to really think about not just the rates, but you have to think about your entire business plan. What are you doing with cash? Are you pumping it out to the company? Are you paying it out to shareholders? What's your exit strategy, stock, asset? What's the likelihood you can sell stock? Is the 199A eligible? If they keep the 199A, then I think the pass-through vehicle, S Corps and partnerships continues to be a pretty attractive choice. So just make sure you're having these discussions with your tax advisor before year end. That's all I got. And just as long as you're keyed in on this, that's my most important takeaways. Just make sure you educate yourself during the year because I expect this stuff to rapidly change.
All right, we have a couple questions. One, both these are sort of general in nature and then not specific in any area. So we'll give you all a shot to see if you've got an answer. One is how will an increase in the minimum wage affect manufacturing? I don't know that we really know that answer. But obviously, you raise the input prices, you're going to have some sort of impact on the other side, either increase prices or doing it more efficiently. So any thoughts around that topic in terms of minimum wage and the impact of the economy, the business, different sectors, manufacturing?
I think
Go ahead.
I agree. It'll negatively impact manufacturing, but the pain won't be necessarily felt equally. It kind of depends on which manufacturing sectors, because some are more dependent on their manufacturing model may employ a higher skilled, higher cost labor anyways, and won't feel the pain as much. And smaller businesses tend to use more human labor as opposed to automation, so they may feel the effects more harshly than a larger manufacturing organization. But Robert or Rob may agree or disagree.
No, I think I agree. I would also throw in geography there. The folks that have increased the minimum wage $15, $15 in Seattle may make sense as a minimum wage for waiter or waitress or somebody at a Starbucks. Doesn't make a lot of sense in the middle of nowhere, Texas. $15 in some small town in Texas as a minimum wage would definitely have an impact, I think. So
Rob, this question is for you. do you have any insights or thoughts around thresholds for net worth based taxes?
The net worth tax, there's three, actually there's two proposals that have been proposed. One is the widened proposal. I hope I'm not butchering that. If you have above 1 million of assets or above 10 million for 3 consecutive years, then there's a certain tax that kicks in on gains. So an additional tax on gains. So basically a million of assets in 1 year or 10 million for 3 years. The other one that I've seen is it's called the Warren proposal. It is a net worth above 50 million, subject to 2% tax, and then a 1% tax on net worth above $1 billion.
So are you telling me I don't need to worry about this?
Maybe the million one, Brian. Yeah.
Hey, Brian, I need to address that geopolitical question about M&A from earlier.
Oh, yeah.
We deal with small companies, so geopolitical probably isn't as big an issue, except in the area of supply chain. And we're already seeing there's been a lot of disruption in the supply chain. That has become a bigger and bigger due diligence issue. And any geopolitical risk will play out generally for our clients in that area.
Okay, well, we are right now at 6 o'clock. So we were not gonna, unless I don't see any more questions. If there's any final comments or not, I certainly want to thank Robert and Jonathan and Rob for your time and your insights, and we truly appreciate it. So unless y'all have any parting comments or wisdom, we can probably call this a wrap. So
Thank you. Appreciate it.
Silence as we can now end. So thank y'all.
All right. Take it easy. Thanks.